The economy doesn't run on money first. It runs on belief, not optimism, not hope. Belief, the kind you don't notice until it disappears. Imagine waking up tomorrow and realizing everyone has quietly decided that tomorrow doesn't matter. Not next year, not next month. Tomorrow. That single change would break the economy faster than any war, virus, or market crash. Because stability isn't enforced. It's agreed upon. And right now, that agreement is under stress. This matters today because the global economy looks stable on the surface. Markets still open. Salaries still arrive. Prices still update. But underneath, the system is more fragile than it appears. Not because the math stopped working, but because belief is getting thinner. And belief is the real currency. Let's strip this down. Money has value because you believe someone else will accept it later. A job has value because you believe the company will exist next month. Debt works because lenders believe borrowers will keep playing by the rules. Governments function because people believe their promises are mostly real. None of that is guaranteed by physics. It's social agreement. Take away belief and the equations still look fine, but the system stops moving. This isn't theory. We've seen it happen. In 2008, banks didn't collapse because they suddenly ran out of math. They collapsed because trust vanished faster than liquidity could replace it. Institutions stopped lending not because they didn't have money, but because they didn't believe the other side was safe. The moment belief broke, everything froze. Credit markets seized. Companies panicked. Governments stepped in, not to fix numbers, but to restore confidence. Because confidence is what keeps people acting normal. Here's the uncomfortable part. Economic stability doesn't require everyone to be rational. It requires everyone to believe everyone else will be normal tomorrow. That's it. If workers believe they'll get paid, they keep working. If consumers believe shelves will be stocked, they don't hoard. If investors believe markets will open, they don't rush exits all at once. Belief smooths behavior, and smooth behavior keeps the system alive. Now let's talk about money creation because this is where belief becomes visible. Most money isn't printed. It's created through loans. When a bank issues a loan, new money appears. Not because cash was moved, but because the borrower and the bank both believe the future will cooperate. The borrower believes they'll earn enough to repay. The bank believes the borrower believes that. That sounds circular. It is, and it works until belief cracks. Once belief weakens, lending slows, spending slows, hiring slows. Nothing dramatic happens at first. It just feels cautious, then fragile, then suddenly unstable. This is why governments obsess over confidence. Consumer confidence, market confidence, business confidence. They're not using buzzwords. They're monitoring belief levels. Because once belief drops below a certain threshold, incentives stop working. Rate cuts don't help. Stimulus loses power. Even cheap money doesn't move if people don't trust the future enough to use it. Here's the irony. The economy is often strongest when people are slightly wrong. They overestimate stability. They underestimate risk. They assume continuity. That mild delusion keeps things running. When everyone becomes perfectly realistic at the same time, systems break. Now zoom out. Modern economies are built on promises stacked on promises. Pensions promise future income. Bonds promise repayment decades ahead. Currencies promise acceptability. Governments promise order. None of these are fully enforceable. They're credible because they've worked before. History creates belief. Belief creates stability. But history only works until it doesn't. This is why inflation scares people more than recessions. Not because prices rise, but because inflation signals that belief is leaking, that the future is less predictable, that the promises are getting softer. And once people start acting like promises won't hold, they accelerate the very instability they fear. Belief is reflexive. We believe because others believe. Others believe because we do. Break that loop and the system doesn't explode, it erodes. Slowly, quietly, unevenly. Some people notice early. Others don't until it's personal. This brings us to the uncomfortable math. Economic models assume behavior, but belief controls behavior. You can have strong GDP numbers and weak belief. You can have low unemployment and high anxiety. You can have record markets and fragile foundations. Because numbers describe the past. Belief determines the future. So when people say, the economy is strong or the economy is weak, they're often really saying, I trust the system or I don't. And trust is emotional before it's logical. Which raises the real question. If economic stability requires belief, and belief depends on shared trust, what happens in a world where trust is thinning, where institutions feel distant, where promises feel negotiable, where the future feels less solid than the present? Does the system adapt? Does belief reset? Or does stability quietly decay until something forces belief to snap back? Or break completely? Because in the end, the economy isn't a machine. It's a story we all agree to act out. The only question is how long we keep believing the next chapter will make sense.